Tim Quas, what's going on? This is the founder and CEO of Modern IR and Market Structure Edge. If you guys haven't checked it out, definitely go to marketstructureedge.com. You can get your free trial. Just check it out. You don't even need a credit card. I did so myself. I think you guys should definitely check it out.
That was quite a wind-up. Thank you very much for that. And I want to add I want to add my kudos to yours for Dennis and Joel as well, and what a great job that Benzinga does educating traders. I've said this before. I said it to Neil last week that look, you're running circles around everybody else in the market for helping people understand how to navigate today's complex marketplace, and you do it well every day. So I hope people appreciate the good work that you're doing.
Real good on Mondays. For some reason, we're so much better on Mondays.
Actually, I'm hurting. I'm tired. It's been a long weekend for me. I had some friends up. This has been a long weekend. You can tell. I'm tired. This is a tired Monday for me.
So we got Tim. Bring the power, Tim.
Yeah, bring us the energy, because I'm like running short. I'm running on 10% energy here right now. So we need the Tim. Let's bring the energy here. Let's see some market structure. Let's see some numbers. Let's talk these airlines. We just talked down the airlines here.
Did you?
Well, we didn't maybe necessarily. We were just saying the last 2 weeks these have went down. I don't know. Like, have they come down enough where you start getting interested again, or is these charts just a little bit too broken to try to call the bottom?
They're negative. They're negative too. Have you had a negative reading on the market structure, Tim?
Oh, are they negative? And let's go like pick on American Airlines. Let's go to American Airlines.
So if that happened, Joel, it would be like oil futures, right?
Oh, my goodness.
Right.
That was scary. Negative oil.
Well, here I'll and thank you for mentioning this. But you traders, you can do this, and the reason to me that this matters is no matter what happens, and we could talk about monetary policy. Boy, that'll clear a room. You want to clear a room at a cocktail party, say monetary policy. But I think that there are some important things to understand about how to navigate the stock market and the effects of supply and demand. It's the most basic principle of economics, and it applies to the market. So I'm going to show you. Let's look at the airlines and cruise ships. I like to look at them together. So if you've never done this on Market Structure Monday, where we talk about market structure, behavior of money behind price and volume in context of rules. There are rules that govern how the market works, and it helps us to understand supply and demand in the market. Sorry, let me get my face out of there. And it's important to understand, because otherwise you're just deploying tactics without strategy. And I've mentioned this before from Sun Tzu. Tactics without strategy is the noise before defeat. We don't want to get defeated. We want to understand how supply and demand wax and wane. So this is what Market Structure Edge looks like. And you can try it. Just try it for free, and you can follow along and see supply and demand. It's not perfect, but it's a very good way to understand the way that the market works. So here are airlines and cruise ships. I've got 11 components in here. The lead behavior is fast trading. Those are the machines behind, call it about 53% of market volume in the S&P 500. And they don't want to own anything at the end of the day. So the algorithms are designed to deceive people, and you have to beware.
I want to actually take you. I had this question on Saturday, and it got me thinking to a certain extent. You notice how in the last 5 minutes of the day, it seems like 80% of the time they jack up the S&P and they jack up stocks for the last 5 minutes. Do you think that, to the point that you're just making, there's so many traders that don't want to own anything or don't want to be short anything at the end of the day, that you actually have day traders and short-term traders that are simply covering shorts that are jacking up that natural short covering action is jacking up the market in the last 5 minutes? Because this has been a trend I've noticed for the last year. It seems like, wherever we're trading, the last few minutes, they just get a little spike there at the end. Do you think that has anything to do with that?
I think that there are three things going on into the close. That's one of them. It's the amount of money that wants to be flat. That's the term that you would use where you have no real exposure. Number two, there are the same very sophisticated folks from Hudson River Trading to Infinium and GTS and Jane Street and Jump Trading and Tower, and Citadel and Virtu, and I'd call Virtu kind of the good guys in that group, but they still do this too. They are all running calculations to understand where the reference prices are going to be into the close. So that's number two. The reference price, by the way, folks, is the price that the indexes and exchange traded funds want. They want to be as close to the measure that they're trying to track as they can get, because tracking errors reduce your appeal to investors. Well, that happens in the last, it's market on close. It's where things are going to be. And then the third piece is that there is so much money tracking benchmarks and trying to have limit or market on close orders that it inflates what happens at the end of the day. That's what to me is going on. So you have to be careful about that. You can be fooled, traders. These people are very sophisticated. They're, as we've talked about before, the machines are sitting right next to the exchanges servers. They know what supply and demand are. You know, I like to talk about, say, Walmart. Walmart knows at all times what the traffic in its stores is every day. They know if traffic is increasing or decreasing and from which demographic. Well, you should too. The stock market is a market. And if you're going to be in it, you should understand things like this. Here are airlines and cruise ships. What this is telling us, the top graph, is demand. So demand above 5 means that demand is greater than supply. Demand below 5 tells us that the supply is likely greater than demand. And then the below is a supply measure. So you have demand and supply. Supply is short volume. And so, there's a really interesting point to me that I want to talk about related to fund flows, which have been enormous in 2021, and yet the market struggles. And I'll explain that. But see the trend in short volume? While it ticked down a little bit into options expirations, that was Wednesday, Thursday, Friday last week, the trend isn't great. Supply is increasing and demand is decreasing. What does that tend to do to prices? It's not perfect, but it tends to mean prices don't rise. You want to find rising demand and stable or falling supply. That's how you find things to trade. And if I look across the market, moving from airlines and cruise ships, I've got some things in here I'd like to point out for you traders, good benchmarks to consider, and we'll talk about that. But back to this whole idea of supply and demand, that if there's an overwhelming amount of demand, money flowing in, like $780 billion has flowed into debt and equity markets, according to Morningstar, through July of 2021. It's an all-time record. It beats the previous record by almost 100%. And yet, why isn't the market then up 50%? Because the supply is increasing at the same time. If you can shunt money into derivatives and into exchange traded funds, they're not driving the underlying equities up at the pace that you might expect. Well, at some point, there's going to be a nexus. All that money that goes into those substitutes is not going to continue to carry the market higher. And you can see it everywhere. It's an economic principle. Look at the Fed's balance sheet. There are $4.2 trillion in excess reserves, meaning the banks don't know what to do with it. In 2007, excess reserves were $10 billion. I mean, it just staggers the imagination how much stuff is sitting around with nowhere to go. Well, you'd say, well, that's going to lift the market. No. If prices stop rising, the opposite thing occurs. They stop rising and begin to deteriorate. People then want to sell. Then you've got all this excess out here and people don't want to own the asset. What happens to the asset prices? Well, they go down. This is an ancient principle. We have known it for hundreds of years. Copernicus articulated it. So to me, that's very important. You have to think about that when you're trading. Where is the supply demand opportunity? And
yes, let me just add on to that, Tim,
Mitch,
because I've been starting to study on my CMT, and it's just more and more do you find out that, you know, people like to always refer to where are the buyers, where are the sellers, instead of asking the question, where's the supply and demand going? I definitely think this is how you really start staying on top of rotations and staying on top of the market versus asking buyers and sellers. I mean, there's always a buyer and seller, right? I mean, there's markets are efficient at that one moment. So the better question is, where's the supply and demand leading?
Exactly. And the purpose of the buyers and sellers, we have always believed that there has to be a buyer for every seller, right? And yet, as Dennis will affirm, only about 5% of trades actually execute. Almost 95% of trades cancel.
Yeah, that's true.
It's because there's not a lot of liquidity in the market. I talked about this last week for edge users, and I send in Market Desk. I write it myself every day, and I talked about how the real liquidity in the stock market is 60 shares. The average trade size in the S&P 500 right now, the components, the 500 stocks comprising the S&P 500 is 104 shares. That's the average trade size. The minimum for a quote and offer under regulation national market system is 100 shares. So we're barely over what prices are quoted at. Then 44% of those shares are borrowed. That's the supply side. So in reality, there are 60 long shares. So think about that. The likelihood that you can fill a 100,000 share order is a number approaching zero. And so everything gets split into tiny little trades.
Yeah.
And that's what the whole $50 trillion of market cap is, depending on how efficiently 60 shares can move.
Yeah.
And so you have to think about that. And Mitch, to your point, if you're a fast trader, your investment horizon is a day or less. So you could trade something thousands of times, but your aim is to say, if I'm long 500 things, I'm going to be short 500 things
That's me.
too. There you go. Exactly. That's right. You don't want exposure. Exposure is risk, right? And people just don't think about that. That's what's going on. We tend to think, oh, there's all this massive amount of money in the market. Well, the horizons are very small for an awful lot of it. And that's important to understand.
Market neutral. Dennis says it all the time.
Market neutral.
That's what we talked about on Saturdays, is trading market neutral. It's a different style of trading. Obviously, the majority of our listeners are probably long only. A lot of them have never made short trade before. And I'm not saying, shorting is the way to go. I'm just saying the professional traders are short the 500 and long the 500. They're keeping that. They're looking at what their exposure is overall. Not even when you get that many positions on, you're moving around a lot with the overall market. Uber being down 3% is a drop in the bucket when you have that many things on at the same time, and they're just trying to manage that overall market exposure. That's what the professional firms are doing.
And traders, that doesn't mean if you start to think, oh, how am I ever going to survive that kind of market? You don't have to do that. I mean, that's for sophisticated folks like Dennis. The rest of us, what we want to do is increase the probability that we're on the right side of the trade, depending on what you want to do. If you short things, then you want to short things where demand is falling and supply is increasing. I can show you that. And vice versa. If you want to be long something, increase the probability that you get a return by buying things with rising demand and stable or falling supply. Again, that's these two lines. So here's Roblox. Now we talked about it last week. I said, well, it's a 10 out of 10 and short volume is above trend. I don't like that. That's not a high probability trade. And so sure enough, very difficult to get a return in Roblox unless you're in and out during the day, because the demand side is falling. Supply is right at trend, but if demand is falling and supply is at trend, what is the probability? Well, the probability is the price will go down. So doesn't mean that it will be perfect. It can be very lumpy, but that's how you help yourself in a situation where you're competing with very sophisticated folks. You don't have to be sophisticated. All you have to do is check supply and demand. Do it once a day. I do it before the market opens. I look at the stuff I've got. I look at what it's telling me. If demand's falling, Nvidia, I got out last week because demand's falling, supply is about stable.
Show us. That's interesting, because Nvidia just made a new all-time high, and typically people, technicians will be like, don't sell stocks making new all-time high. What are you seeing in your system that makes you want to take your profits in Nvidia?
Right. So here's Nvidia, and again, demand line, supply line. And so when something goes up, there's a cause and effect. So the effect of rising demand may not manifest today. Could be 3 days from now, could be 5 days from now. But I know that by the time it gets to 5, I'm probably or thereabouts, maybe just below, because when you look at Nvidia, its gains tend to come between about 4 and 4. So from 4 all the way to 10, the return to 4 because there's a delayed effect. That's where the gains are. So I look at this and say, this is why I left on Friday. Well, demand now is below 5. Probably it's not going to go any higher. If I get any kind of gain, I'm going to take it. And so, and I know a lot of edge folks who listen did the same thing, got good gains. I heard from
it just popped $20 from the low, so it's just a nice move.
It did. Now, is it probable that it can continue to do that? Well, it depends. If demand returns, it can. But you want to always know that. You want to know where it is. There's the higher probability is to buy rising demand. Once again, it's not perfect, but if it's 85% of the time, that's where you want to be. That means that you've really stacked the odds in your favor. And that's what you want to do. And you want to think about that over the whole market. I have a set of companies in here from Tesla to Unity Software, and I want to look at what the trends are. Well, none of them are up, right? None of the trends are up. Well, now I know it will be like Winston Churchill said in the summer of, it was actually May of 1940, Battle of Britain. He said, I have nothing to offer but blood, tears, toil, and sweat.
Huh.
I'm not saying that the market's going to be quite like that. I wish we had some Churchillian verve in our current geopolitical state. But you look at this and say it's going to be very, very difficult in this kind of environment. If I look at Tesla, it's 2.6 and down. I look at Facebook, and I like Facebook. It's 5 and topped. It means the supply and demand is about right. But I look at this and say it's going to be very challenging as August concludes to get consistent gains because the supply demand data tell me. If I can't find good trend lines up, then I'm going to be very cautious. And that it's the way that you have to think about things. If you're just looking at a chart without understanding supply and demand, you're setting yourself up for giving away all the gains. And we want to take gains, not chances. That's the way to think about the market.
All right. This is something definitely to keep on watch, guys. And like Tim says, you can take a look at it in the morning and then understand it, then use that to go ahead and get into your trading day. When I use this is exactly what I was doing. I have a tendency of always looking at sectors and industries and trying to find where the supply and demand is going. This is definitely one of those tools that can help you do that. All right, that's probably going to do it for us, Tim. I appreciate you coming on. I hope you're enjoying Steamboat. No more smoke out there and enjoying the mountains. I got to do a little hike this weekend, so I'm sure you're enjoying it also, Tim.
Well, I'll give you a little weather report from up in the high country because we tend to be ahead. So on August 20, Friday, Trail Ridge Road in and out of Rocky Mountain National Park was closed due to whiteout conditions. We've already had our first snow. It was wind chill of 16 degrees. I can look out on Emerald Mountain where we had a full moon today. And watched it set because I'm up early, and there are yellow aspen leaves. There are just a sprinkling of them, but it's 42 degrees out here. I've got the fire pit going out on the patio. So autumn is coming, but we love it. That's okay. Warm days, crisp nights, we'll take it. Have a good week, guys.
Definitely. Have a good one, Tim.